Hello there, welcome to the Vital Investing channel, where I'll synergize value investing and technical analysis with long-term perspective to achieve outstanding financial returns. The stock market was in deep sea of red with Nasdaq plunging more than 3% after the Fed meeting on Wednesday. A very rough start for week 1 of the year 2022 indeed. So yes, it's kind of scary, at least psychologically, to see one's trading account taking a deep dive into the red zone in such a short period of time, literally wiping off most of the gains over past months. So why is the market so volatile and nosedive? Key trigger number one is that after the US Federal meeting on Wednesday, it signaled that the raise in interest rates may be sooner than expected, coupled with the US 10-year Treasury bond hitting a record high of 1.7787% since last April. Many growth stocks will be heavily corrected, if not already crashed. As such, the market will tend to shift capital from equities to bonds. Now, to nurse our wounds, let me share a quote from my idol Warren Buffett. Unless you can watch your stock holding decline by 50% without becoming panic-stricken, you should not be in the stock market. Now please take a close look at the above mentioned percentage. It's 50%. Frankly, I'm not exactly sure if I will really not be panic-stricken if my portfolio is halved. But I believe that with the vital investing framework I'm adopting, where I only start to enter a position when the MFI money flow index is below 20%, signifying oversold territory and moving average reaching appropriate support levels, etc. I'll share more on my vital investing's technical analysis methodology in upcoming episodes soon. Over the years, I've made my technical analysis process super key, keeping it simple and sweet, yet effective. For this episode, I'd like to ascertain my investing strategies for 2022 amidst such extreme volatilities and many expected and unexpected events. Strategy number 1: follow a system. SYSTEM stands for Save Yourself Some Time, Effort and Money. Having a good investing system will help to avoid both traps and catching wrong falling knives. Alright, I admit, having a system will not entirely eliminate the risk, but it will sure reduce emotional trading loss. Strategy number 2: only buy fundamentally strong companies which you have strong convictions in and that you are willing to buy and forget and hold for a long term. With a long investment time horizon, probability for investment success will be near 99% since historically the stock market will always edge higher and higher over time. Strategy number 3: proper portfolio management. Never let emotion get the better of you and go all in. It's important to invest within one's limit. Never invest with money that you need to put meals on the table for your family. There is one caveat for better portfolio management though. It's easier to perform portfolio management when one has a much higher investment capital. It's ironic, isn't it? That's why the saying, the rich will get richer. As such, other than investing to grow my wealth, my other key project is all about generating multiple streams of incomes online to supplement my investment. If you are also interested in building sustainable online income being a webpreneur, do join me in my main channel, amwotan.com. For this episode, I zoom into the above mentioned strategy number 2 on the list of companies which have higher conviction and more than willing to hold them for the long term in my coffee can. So taking a quick glance at my US watch list, I have Apple, Airbnb, Adobe, AMD, Amazon, Alibaba, Costco, Salesforce, Disney, Facebook, Microsoft, Nvidia, PayPal, Sea Limited, Tencent, TSM, Unity, Visa, etc. There are many more like Bilibili, CleanSpark, CrowdStrike, Dollar General, DocQSign, Etsy, Fiverr, GoodReceive, Cloudflare, UiPath. The list is long. Just that the convictions are not as high as the previous list and many are growth stocks which are heavily bettered as of late. I'd only start a very small position when there are really good technical buying signals. Back to my higher conviction stocks, I'd strongly recommend to accumulate them via DCA dollar cost averaging. Amongst many of the techniques I've learned and experimented, the DCA technique is really a much superior method compared to timing the market and lump sum all in at presumed lows. If you see this popular image on the story of 3 friends who all saved $200 monthly and invested in an S&P index fund, with Tiffany trying to time the market but turned up she somehow always got the worst timing ever. Then, we have Brittany who waited for the so-called perfect timing and bought only at the bottoms. Last but not least, we have the slow and steady Sarah who adopted DCA dollar cost averaging and invested $200 every month without fail and never looked back. Let's take a look at their returns after 40 years. Yes, I know 40 years is a very long time, but precisely because of the long investment time horizon, all 3 of them have excellent returns over the years. Yes, even with Tiffany's terrible timing, thanks to her buy and hold DCA strategy, she still managed to turn her $96,000 to over $663,000. Brittany is closing into $1 million, and check out Sarah with a staggering $1.3 million. This confirms that time in the market is definitely superior than timing the market. And guess what? One of my very trusted investment mentors did a thorough back testing on the above techniques with 40 years of S&P data and verify and double confirm that dollar cost averaging is supreme. So now that we have the vital framework and prudent portfolio management with dollar cost averaging technique, we will be able to weather through the market volatility in 2022. See you soon in the next episode.